Welcome to Success Series. Today we are going to talk about financial liability. Financial liability. Let's dive into today's lesson. Now, what is financial liability? So, financial liability is any liability that is contractual obligation either to deliver cash or another financial asset to another entity. An exchange between a financial asset and a financial liability which is under potentially unfavorable conditions. Financial liability is also seen as any liability which is from a contract that will or may be settled by an entity's own equity instrument. So, in an instance in which you have to use your equity instrument to defray or to settle the liability, it is also a financial liability. And finally, it's a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instrument or a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instrument. This implies that we could also defray the liability, it also settle the liability by using the entity's own equity instrument in a settlement as well. So this is basically the definition of financial liability. Let's dive into the measurement. Now, the measurement is enshrined in IFRS 9. So IFRS 9 gives the initial measurement you have to follow and that of the subsequent measurements. Let's first start with the initial measurement. Initial measurement for financial liability is fair value, and then you adjust the transaction cost based on the subsequent method you adopt. So bear in mind that financial liability, we have two major methods. It's either you any of the methods will let you know how you are supposed to account for the transaction cost. So let's go into the subsequent so that we'll get to know the subsequent method. Now, subsequent measurements. The first method that we have is the amortized cost approach. The amortized cost approach. Over here, the transaction cost will less the transaction cost from the fair value. So it implies that if you are doing the initial measurement using the amortized cost approach, you will pick the fair value of the instrument and then you less the transaction cost. And then we have the other method, which is a fair value through profit or loss. Now, fair value through profit or loss means that you need to pass all your entries through the statement of profit or loss. Hence, if you have transaction cost, we rather what expense transaction cost. So by the initial measurement that the transaction cost you have to expense it. Meaning that the initial value will just be the fair value, and then the transaction cost will be accounted for separately in statement of profit or loss as an expense. Now let's pick a question to augment our understanding. Question 1. Dios Limited issues 5% loan notes at a nominal value of 20,000 Ghana cedi with an effective rate of 5%. The loan notes are repayable at par after 4 years. Required. A. What amount will be recorded as a financial liability when the loan notes are issued? So when the loan notes are issued, what are you going to record? Now remember in mind that this is talking about the initial measurement. So the initial measurement will be fair value and then we adjust the transaction cost based on a subsequent method. Here, we are going to use the amortized cost approach. Why? We have been given the effective interest rate. If the effective interest rates have been given to you and any method has not been stated, you use the amortized cost approach. Then B is telling us that what amount will be shown in the statement of profit or loss and statement of financial position for the years 1 to 4. 1 to 4. Let's dive into our solution. So first thing we have to do the initial measurement. How do we do the initial measurement? You have to ask yourself, what's the value that the loan notes were issued for? So that value that our loan notes were issued for, we'll do the double entry of it. So we are going to debit bank with 20,000 in respect of the loan note, the amount of money we obtain from the loan note. And then we'll credit our loan note because it's going to be a financial liability we are going to record in our statement of financial position. Then before we move on to the subsequent method, now to do the subsequent method, we need to amortize. We are using the amortized cost approach, so we need to amortize. How do we go about it? We first have to bring our amortization schedule. So this schedule will guide us in our preparation. We'll need a year. We need opening financial liability. That's the opening balance of a financial liability. We'll calculate for our finance cost, and here we have given the finance cost at the effective interest rate at 5%. Then we have the cash paid or the coupon amount. And bear in mind a coupon amount here we obtain it from the coupon rate. And what's the coupon rate? The rate attached to our instrument. So you realize that we're given a rate which was attached to our instrument, and that's the coupon amount or cash paid in this instance. Then we'll get our closing financial liability. So let's do that for the respective year. So year one, the opening financial liability, the opening balance of our instrument, the initial value was 20,000. We calculate 5%. We need to calculate 5%. We need to calculate 5% of this amount. So we calculate 5% of it on the 20,000. And then the coupon amount was 5%. We calculate 5% on the nominal value. And then bear in mind, you need to subtract. So we need to subtract the cash paid from the summation of the opening balance and then the finance cost. And that will give us our closing balance. Then we'll do the same for year two. So bear in mind, our closing balance for year one becomes opening balance for year two in that regard. Bear in mind that here the values are the same because our finance cost rate and then the coupon amount rate are the same. If they are not the same, you'll be seeing some differences. Our next question will help us. The next one is 20,000, same thing, same for year four. But bear in mind that year four was when we were what? Redeeming the instrument. And bear in mind that whenever you're redeeming the instrument, the cash paid column that we have there, you're not only going to pay the coupon amount, you will pay the coupon amount as well as the nominal. Bear in mind that whenever you're repaying a loan at the final year, you don't pay the installment amount alone. You pay the principal amount plus the installment. So over here, you need to include the principal amount or the nominal value to that of the last year, which is going to be 20,000. The principal amount was 20,000. When we do that, the closing balance won't get any value over there. So this is how we do the amortization schedule before you present them in your extract of financial statements. So now let's go into the extract. Here we've read the statements of profit or loss for each of the years. We are having 4 years in our question. And you are going to bring what? The finance cost. So the finance cost for each of the year, it was 1,000, 1,000, 1,000. We have to show them. And then we move on to statement of financial position. Over here, we record the closing balance of our financial instruments. So we bring the respective years, and here, a portion of it will be non-current. That's that. When you check the amortization schedule for year one, year two will be non-current, and year three will be current. Why will year three be current? Because year three it was left with only 1 year for us to pay. So for year one and year two will be non-current. And then non-current liability was 20,000 for year one and 20,000 for year two. Then year three will be a current liability. Will be a current liability. So this is how we go about with the first question. Let's dive into the second question. Question 2. On January 1, 2016, Swan issued 3 years, 5%, 300 Ghana cedi loans at a nominal value with effective interest rate at 5%. The loan notes will be redeemed at par. Now we're told that the fair value of our loan at January 1, 2017 is 294,501 Ghana cedi. Now let's say the transaction is classified as fair value through profit or loss. So bear in mind that here we are using fair value through profit or loss. We are using fair value through profit or loss. Through profit or loss. This is what you have been given. So bear in mind that the period involved here was 3 years. The period for the instrument is 3 years. And then the nominal value we're given is 300,000. Let's check. This will be our coupon rate. Remember what I said coupon rate is? Coupon rate is the rate attached to your instrument. So you realize that's the rate which was attached to our instrument. And then here we're giving the fair value on January 1, 2017. Now the fair value on January 1, 2017 will be the closing balance, the fair value closing balance for 2016. So 31st December 2016 is going to be our closing fair value, which we'll need for the fair value through profit or loss. But surprisingly, although it was fair value through profit or loss, you realize we're giving effective interest rate. So bear in mind, whenever you're giving effective interest rate, we still have to calculate for our finance cost. So in this question, although we are not using the amortized approach, the amortized cost approach, we still have to calculate for finance cost because we're giving the effective interest rate. Now, let's dive into the requirements. Required. Illustrate how the loan is accounted for in the financial statement for 31st December 2016. So this is just for 1 year. They want us to account for the transaction for only 1 year, which is 31st December 2016. Let's dive into our solution. Now, first, let's have to start with the workings. Yeah, we'll prepare more like amortization schedule because we have a finance cost. If you check in our question, we're having a finance interest rate of 5%. That will mean that we have to calculate for the finance cost on our opening financial liability. Then we're given a coupon rate also of 5%. The coupon rate per the question was also 5%. So we'll calculate 5% also on our nominal value, and then we'll get the closing financial liability. And over here, we'll need our remeasured value. Our remeasured value here will be the closing fair value. So the fair value we're given as closing will be the remeasured value. And then we'll compare to see if you have a fair value gain or fair value lost. Let's check. So here, the opening financial liability here was 300,000. We calculate 5% on this 300,000 and that will give us 15,000. Then the cash paid as well, we have to calculate 5% on the nominal. Bear in mind that cash paid is always calculated on the nominal. So you have to always calculate it on the nominal. So the nominal too was still 300,000. So we calculate 5% on 300,000, which will also give you 15,000. That will make our closing still 300,000. Then we bring our remeasured value. Check in the question, we're given a remeasured value. So we have to bring our remeasured value. So our remeasured value per the question was 294,501. Then we compare this with our closing balance and check if you have a fair value gain or a fair value loss. So let's compare. So 300,000 against 294,501. Would the difference be a fair value gain or it would be a fair value loss? So you have to check. Here you realize that this is a financial liability, and you realize that here when we remeasured our liability was reduced, it came down. At first it was 300,000, but now it's 294,501. This should tell you that the difference is a fair value what gain. It will be a fair value gain. So the difference that we have of 549 will be 5499 will be our fair value gain that we are going to account for. Now let's dive into the extracts. Now we prepare our statement of profit or loss for the year ended 31st December 2016. What do we have to show here? Here, remember you have to show your finance cost and then the fair value gain or loss we also got from the transaction. So here we'll bring our finance costs here, which was 15,000, and the fair value gain that we obtained, which was 5,499. And then we also have to prepare our statement of financial position. And here we are going to show the closing balance of our instrument. And here the closing balance of our instrument will be its fair value, which we're giving us 294,501. Thank you.